Hi, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. My colleague, Victor, is also in the room. Hello, Victor.
Greetings, Fawad.
Greetings to you, sir. How are you?
Very well. As you mentioned, we have a very exciting week ahead of us. It already started with some interesting news out of Australia, but before we get to that, let's start with our usual disclaimers and warnings.
Sure. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So this is the agenda for today's webinar. We will have a brief, fundamental overview of what's happening and what to expect to happen this week. As Victor mentioned, we have a few major central bank meetings, and overnight, one of them, the RBA. Well, what did they do, Victor? Can you enlighten us on that?
Yeah, the RBA dispelled any worries by the markets that they might hike rates soon.
Right.
They didn't do that. I mean, they didn't signal anything like that is coming around the corner. So people are taking profits both across the Aussie and the Kiwi as well.
Mm-hmm.
But generally, if you switch over to the Kiwi, it's right on top there. Yeah. So it's mimicking the same thing that the Australian dollar is doing. These economies are perceived by the market to be pretty close to each other. So when one of the central banks acts in a certain way,
the other one follows suit.
The market expects that the other one is not going to be much different than that. So that's what's going on here this morning. These two commodity currencies are, really getting hammered. 0.8% for the Aussie, 0.6% for the Kiwi.
Yep.
And this is in tandem with some risk-off sentiment and the Japanese yen is rising and in my opinion, signaling the market is starting to signal that, oh wait, maybe things aren't as good as we thought. We've had some pretty downbeat data from the US lately.
We have, yeah.
starting last week with the pretty disappointing GDP figures, and on Sunday some Chinese data about contraction in manufacturing really raised some eyebrows, and considering the housing prices in China that are still exorbitant, I feel like we are yet to see more pretty disappointing numbers all over the board. But anyway, what we did get from the US was also, if you can scroll up a little bit, the manufacturing PMI that came out at 60.8, which was better than expected, but not by much. So, and also that let's not ignore the fact that considering the supply chain issues globally, local manufacturing in the US actually could expand and benefit from the supply chain issues that are encircling the globe, and the cluttering of shipping containers across ports in Asia, Singapore in particular. So yeah, let's see how that evolves. But for now, the dollar is looking forward to tomorrow.
Indeed. Just looking at the ISM manufacturing PMI, just a few things to note. Prices once again came in.
Oh my God!
Stronger.
Yes.
And employment increased very strong. Yeah, the prices. But notice new orders fell quite sharply. So, although the headline PMI was above expectations, the devil is in the detail.
That makes sense. Like when prices grow, orders come down. So there's like if you look at in particular home builder and home buyer sentiment, that is not on the cards. Like you don't look for it in the calendar. But the home builder sentiment in the US is at all-time highs due to real estate prices, and the home buyer sentiment is at all-time lows.
Sure.
So, who's where's the chicken and where's the egg? What drives what? So we're gonna find out in the next couple of months, and I suspect that the consumer is going to be the chicken.
we have quite a few things coming up this week. So RBA, decided not to hike. Obviously, as Victor mentioned, we have employment data coming out from New Zealand tonight. If you live in the Western Hemisphere or in the Northern Hemisphere, rather, if you live in New Zealand or Australia, obviously this will be Wednesday morning. The employment in New Zealand is expected to have grown by 0.4% on the quarter, a sharp slowdown from the previous quarter. The unemployment rate is nonetheless expected to have fallen. More to the point, we have FOMC on the next day, on Wednesday. The Federal Reserve policy meeting for this month is going to be very, very important for the markets. Ahead of this, we've seen the markets hit new record highs in the US and elsewhere. The dollar has been, pushing up, generally speaking. Let me just bring up the dollar index.
It had a nice turnaround last week. On
Friday. Friday rallied really strongly off of the support area, the dollar index, and then it fell back at the start of this week on profit taking from the longs that had been accumulated during that melt up on Friday. Today it's a touch higher, but it's not moving much, understandably so, ahead of the FOMC meeting that's going to happen on Wednesday. What do we expect from this, Victor?
So we expect the Fed to start tapering its asset purchases, announce that it starts to taper its asset purchases. And if I'm not mistaken, the expectation is that it's going to happen over about 8 months, 15 billion per month of reduction in asset purchases. And that's the consensus out there. I don't feel like we're going to see anything different from the consensus. Despite the slowdown in recent data, the Fed is put into a tight corner as it has to start fighting inflation pressures because there are some signals that the coming the coming pressure on the political class is going to lead to lower trust in the abilities of the Fed to control the situation. So the credibility of the Fed is on the line. They have to start tapering. What's going to happen after? Nobody knows.
So we had been saying that the dollar is going to remain supported until at least the time the Fed starts tapering, and we are at that time now. Do we then expect the dollar to go down now that the news is kind of out of the way? Do you expect that, or do you think it depends really on the pace of asset purchases reduction or some other factor?
I feel like the Fed has been pretty clear about the pace of asset purchases. I don't see them surprising us in any way. We do have some persisting weakness in the euro and in the British pound recently because of the resurgence of COVID cases and the bets that the Bank of England is not going to hike rates. Is it this week too?
Yeah. We've got the Bank of England.
Back to back.
The Bank of England is on Thursday. It's going to be
the market has tapered off its expectations, unlike the ones for the Fed meeting. The market is now not pricing in a rate hike at this meeting by the Bank of England. I wouldn't be that sure, actually.
I think the consensus might be wrong here. The Bank of England has been quite hawkish in terms of raising rates in the short term, but dovish about long-term rates. So I reckon that the Bank of England is going to raise interest rates very slightly. We did write a week ahead report. If you look at go to our website, and if you look here. Ahead of this, the CFTC data shows that the net long positions on the cable on the pound they rose about 8.6% last week. Since then, obviously, we've had a few dovish comments here and there, but still, the Bank of England, I think some economists expect them to increase by 15 basis points. So it's only going to be a moderate increase if it comes at all. But should the Bank of England surprise and not hike, that's what could hit the pound really hard. Or if the Bank of England hikes rates and then says, that's it, we're not going to do another one until...
we're going to stay pat for the next 3 months or something.
That's also another risk. And I think that's what the market's kind of pricing in, that maybe they will hike a little bit, but it's not going to matter too much, or maybe they won't. So it's the market's really not sure, and that's why the cable has been just going, it's been kind of stuck in a range, just to wait and see what happens. So understandably, the cable, there's two sides of the equation: the pound with the Bank of England and the US dollar with regards to the Federal Reserve. Both of these central banks are meeting. It's going to be a wild week for the pound. We have some data as well from the US. Non-farm payrolls are going to be released on Friday. It's going to be a very important week for the cable and indeed for all the other major currency pairs. Expect heightened volatility as we enter the second half of the week now. So it should be interesting times ahead, indeed.
Certainly. So back to the elephant in the room, which is Jay Powell, I assume. The Fed is like the dollar is in our view, if I'm not mistaken, is not likely to benefit from this taper action, as the market has already priced it in. So don't be surprised if we see a spike lower tomorrow, like an immediate reaction to an official taper announcement, which could only be a good opportunity to sell the dollar.
Or buy gold, maybe.
And maybe buy gold. Probably that's the best bet out there. Since according to the treasury market, the Fed is looking to be behind the curve, and that's always good for gold.
So
behind
yields
the
have gone
curve
down a
in
bit.
hiking rates. So the rates have pulled back in expectation of the taper action, and that's something to definitely look at it.
Indeed. So the 10 years they've gone down from their highs hit a couple of weeks ago. And similar action in other yields, including the UK 10 years. We've pulled back from the highs. But, it's not a proper sell-off yet, indicating that the market is just waiting to see what happens with regard to these central bank meetings. But insofar as gold, the metal is still not out of the woods by any means. Okay, so it's still stuck inside a ugly range, I would say. It has though it has broken above this bearish trend line, short-term bearish trend line, which is potentially a bullish outcome. It still needs to do a little bit more, in my view, before the bulls are tempted back into this market.
Well, it's quite stuck to the 200-day moving average, isn't it?
Yeah, it has, and it's kind of struggled each time it tried to break back above it, and so far it's struggling again. We bounced back yesterday, but still around the 200-day moving average. I think, depending on what the Fed does this week, any move above 1810, in my view, is going to be important. Because if we break that level now, we've seen gold struggle at this level or around this level on several occasions, as you can see by the wicks of these daily candles. A closing break above that level, I would think, would signal a shift in momentum. So that's the level I'm looking at, 1810. Break that on a closing basis, I reckon we're going to be heading towards at least 1850, possibly a lot higher over time, depending on the outcome of the central bank meetings.
All right.
So that's gold.
Yeah.
Obviously, we have to consider the downside as well. And for me, this level right here, 1760 or thereabouts.
It's the line in the sand.
It's the line in the sand, because that level was the last low prior to price making a higher high above this high. So if it breaks that low, then I think that would be it insofar as the short-term bias is concerned for the bulls.
Great. So what does it look like from the perspective of silver traders?
Silver, let's have a look. Silver, because it's a bit of a risk-off day today, silver, as you can see by the percentage change, is not doing as well. It's underperforming gold.
It's not doing much. Let's say like 0.7% for silver. It's
nothing
normal
really.
Day. What are the key levels on this chart? I see this red line at 25. Is that important at this point in time? Are we getting there? Are we not?
I had drawn this line before price was approaching it. I had drawn it because I thought it might struggle to get there. Well, it didn't really get there, did it? So it is a psychologically important level, no doubt. I don't think it's going to be very important now because the market's kind of built a high just ahead of it. So what I can do is now I can move this level down to 24.80, 82 specifically, which was the previous high right here. A level which had been tested before. So there's a kind of a double top there, meaning there's going to be lots of stops resting above it. And in the event we see a bullish break from the current consolidation, I reckon it's going to test liquidity above that level as a minimum. So it may reach 25, then pull back a little bit. But the 200-day moving average is where I think it might be headed in the short term, because gold is testing its 200-day moving average and silver's not. So I reckon it's got a little bit more catching up to do on the upside. But it all depends in the short term on the outcome of the Fed. So let's not forget. On the downside, I reckon 23.45 to 23.55, this kind of area, which was previously support, resistance, we broke above it, is a pivotal level. So it remains exposed for a potential retest. Below that, as I said, 23.45. But if we break this low here at 23-ish, this was the last low prior to price making a higher high. If that level breaks, then the short-term buyers would turn bearish once again. It has broken this, or it's trying to break this short-term trend line here. Something to keep an eye on. But I wouldn't pay too much attention to this from a purely technical perspective, just because we have so many macro events coming up this week, making technical analysis a little bit less, let's say, technical analysis is going to play second fiddle to the fundamentals this week.
Right. So what else has been going on recently?
Well,
do we have any more important announcements that we haven't?
We will have the OPEC Plus meeting again.
All
so
right.
the OPEC has been hiking its output by 400,000 barrels per day each month, right? This has really caused prices to stay elevated because demand has been strong and supply elsewhere hasn't recovered as strongly, especially in the US, and that's why price of oil have gone up. Oil consumer nations like India have called for the OPEC Plus to raise output more significantly, say by 800,000.
Right.
But so far, the OPEC, obviously being oil producers, it's in their benefit to produce less oil and sell it for more than produce lots of oil and sell it for cheap. So for them, it makes sense to keep output tight, as tight as possible. But equally, they don't want to choke off economic growth by causing a recession in oil consumer nations like India, Japan, South Korea, etc. So that's why, by the way, the Indian rupee, one of the reasons why the Indian rupee has been struggling, the Japanese yen has weakened, South Korean currency has also, struggled to stay high. And if you look at across the board, some of the other oil consuming nations in emerging markets like Pakistani rupee, it has been falling to record levels. The Turkish lira has been struggling. And most of it's because of high oil prices causing inflation to get even worse for these countries. And the OPEC will be aware of this, right? So do they hike output more aggressively at this meeting? That's something that they could do. One option that I mentioned here is that they could hike output by 800,000 barrels per day this time to reduce the risks of a supply shortage and cause prices to ease back a little bit. And then they could hold off from raising further at the next meeting. So that could be something that they may opt for, but the expectations, consensus expectations, are that the OPEC will once again stick to its 400k barrels per day output target. So let's see if there will be any deviations from this policy. If there is, oil prices are going to move sharply. Technically, if you look at the charts of crude oil, WTI and Brent reached its 2018 high. Don't know if it touched it. What was the high here? The high was 86.68. Just came a few points below, within touching distance of its 2018 high before pulling back a little bit. It has broken a short-term bullish trend line, meaning that the strength of the rally is no longer as strong as it was previously, but this is by no means the end of the bull trend. The US oil contract, the WTI contract, has likewise broken a short-term bullish trend, but the longer-term trend still remains intact. Prices have struggled to hold above 85. 85 being a key level of a key psychologically important level. And you would think that at 85, around 85ish, prices might struggle given the state of the economy and the fact that oil production in the US has started to rise again. Oil rigs have been going up, rising, which all point to increased production in the US in the months ahead.
Right. something that Trump has been on the wires speaking about the disaster that the new administration has created out of the oil sector.
Yeah.
Which I think has nothing to do with the administration, but just with market conditions. So anyway,
You
there
reckon
is.
Trump would have done something about it? Would have been able to do anything about it?
I just reckon that it's just market conditions, and it's not up to the government to do anything about this. So anyway, speaking of politics, there is a very under the radar, an event under the radar, which is happening today in the U.S. There is an election in Virginia for a new governor, and while the Democrat candidate has been well ahead in previous months, he's now barely above the polling numbers for his Republican competitor.
Right.
And it's going to be a very close election in a state which Biden carried by 10 points in just 12 months ago. So it's something to look at from a longer term perspective, because it might mean that Democrats are going to lose the House next year. And,
right.
That would basically block any decisions from Biden to actually lead to something material, So that's something to pay attention to if you're a geeky trader.
Okay, interesting. Yeah, please do pay attention to that, because it could impact the markets, especially the stock markets, if anything.
Well, yes, because when the Democrats, if the Democrats lose positioning, so to say, so to speak, it will be much more difficult to approve budgets, to spend money, all that jazz. So it's important.
It comes just as the S&P 500 is testing the 127.2 extension of its last downswing. Obviously, still at record highs. Keep an eye on the RSI, suggesting that the market is severely overbought. The markets have been melting up without any significant pullback in this phase of the rally. This means that there is increased risk of a unexpected correction, and whether the trigger could be the elections that you've just mentioned or the Fed, it doesn't really matter. What matters is, will the market break down, and at what level will it turn bearish? Well, for me, the previous high at 4,551 is a pivotal level, because we broke above that level here, retested it, held the support, and we broke out again. Therefore, there's no reason for the market to break below this. So if it breaks through this level at 45.51, I think at that point we would turn bearish on the S&P in the short term, which could then lead to further weakness towards these levels shown on the chart at 44.89, a pivotal level, as you can see by the wicks of these candles. Below that, 44.33, and then if that level breaks, the next level down would be the point of origin of the last breakout area at 43.75. So those are the key support areas that the market could potentially reach for. But sentiment is still bullish, isn't it, Victor?
Well, for some reason it is. I don't know what that reason is. Perhaps it's as simple as more people buying than selling.
Yeah.
But
I mean,
I wanted to highlight something that I was
Go on.
reading over the weekend, that
Sure.
the current market cap to GDP ratio is close to 300%,
Oh wow.
which is which is the most overvalued market we have ever seen, and it's now about 2/3 higher. This ratio of market cap to GDP is about 2/3 higher when compared to the dot-com bubble.
That's interesting. That's really interesting.
It's scary. It's not
scary,
interesting.
I mean, if you look at the S&P weekly chart, and to think that this little dip here was in response to the pandemic.
Yeah.
Copy that and then paste that. You can see, to project how much it has risen from after breaking down. It's gone. It's literally the markets have doubled from their in terms of percentage
From their pre-pandemic
high,
highs, and well, did we start producing 2 times more? I don't know, man. It sounds, if anything, looking at these supply chain issues, we're actually on our way to growth is on its way to flatlining very, very soon, unless we invent a small nuclear reactor or something that jumpstarts the economy really, really quickly and raises optimism about the future to even more insane levels. I don't know what's going to happen.
I mean,
it's a very
obviously
hot market.
It is. The market is always right, even when it's wrong, right? So there's no point in arguing against this. But at some point, the market will correct itself. And you always have to be careful at what stage of the rally you're at. Right now, we are at the 200% extension level, okay? So the market is severely overbought. Not just overbought because of RSI, but overbought because of common sense. If you look at...
Which doesn't mean that it cannot melt up in 2 weeks to reach
new all-time highs, even
5,000 or
it's just a warning.
5,250 or something crazy like that.
Sure.
I would actually, every bear market is accompanied by a blow off top. So
indeed,
So
the RSI on the weekly is in the state of negative divergence at severely overbought levels. It has stayed at overbought since April. Meanwhile, it's continued to melt up, so it could still continue higher. But at 200% extension, you'd have to think, the points that Victor just raised. Are you going to be comfortable buying new positions at these levels if you're a new investor, or if you're an experienced investor, or are you going to be thinking about taking profit at these areas? So people who bought the dip here or whatever, I reckon there's increased risk of a downside correction. That correction could be short-lived. It doesn't mean it will be the top of the market, but the risks are, I think, skewed to the downside from here. We have to see that reversal candle first. Okay, so far we haven't seen that, but the risks of a correction are growing as the market reaches to new highs. The other point I'd like to mention is that this has been driven by record stimulus, right? So when the pandemic hit, governments and central banks unleashed record amounts of stimulus money into the market. The Fed's balance sheet expanded significantly. Now that we are reaching a period of time where the pace of asset purchases are going to slow, meaning that the Fed's balance sheet is still going to grow, but at a reduced pace. the market may struggle to rise at the current pace it's been rising. So what we may see going forward is something like this. Okay, so hold on, what's happened here? Yeah, path. So we might see something like this. In other words, consolidation at best near the highs, or if some bearish stimulus comes into the market, we may see a correction of some sort before the markets push higher again. But I don't expect the market to be going up the way it has been going up. If you extrapolate a line of best fit right through the middle of this trend, I don't think the market is going to go up like this anymore. So
Right.
I reckon it's going to be.
I agree. It's either going to be a melt up or a breakdown.
Yeah.
And it's going to be sharp in other ways. It's not
if it breaks down, yeah, it's going to be sharp.
No. I feel like if it breaks up, it could also be quite
really
quick. If you look at one of the components of the S&P 500,
yeah,
your favorite Tesla Motors.
All right.
Just joking. It's not. Fawad doesn't own a Tesla, and I'm not sure if he owns any shares, but this chart is just insane. We've seen this stock rally over 50% over the past month.
Yeah, look at that.
It's mind blowing.
It really is mind blowing. Do you reckon that the other sectors are going to catch up with the Tesla?
The other sectors, I don't know, because
other car makers even
Tesla's market cap is now higher than the market cap of all other automobile manufacturers in the world.
Yeah, think about that for a minute.
Does that make sense? Are we going to be driving Teslas, all of us, in the future?
If not Teslas, we certainly are going to be driving electric cars, right?
Well, that's something that I can buy. Like that's an argument that I can buy. But the market cap of a single manufacturer that has about 2% market share. The market is basically telling us, you see, guys, we have all of these other manufacturers of cars, but they're obsolete. They're going to disappear. Every one of you over the next 10 years is going to drive a Tesla, which is a car that costs about 3 times the average price of a new vehicle in the US.
So what are you saying, that the markets have gone bonkers, in other words?
I feel like, well, it only takes a moment to look at the cryptocurrency market and our favorite Shiba Inu coin.
Wow, look at that.
Yeah, well, as we mentioned already, there was a trade that was put in August last year where a guy put down $8,000. Yeah, well, these $8,000, these $8,000 are worth something like 5.3, or okay, correct me, like they were worth at the peak about 5.3 or 5.6 billion dollars.
Wow.
Billion with a B from 8,000.
I think me and you are wasting our time in the traditional markets, Victor. We need to get on board these crypto.
Yeah, we need to find the next the dog
next
being
Bitcoin.
coined,
Yeah.
and no, Bitcoin is too safe, man. Because Bitcoin doesn't serve any purpose. Coins with dogs are the future.
Indeed. Meme
That's
coins.
what the market is telling
Yeah.
us, at least.
Bitcoin is looking really strong at the moment. It has established a base above the 6,000 mark,
Yeah,
which was previously resistance, as you can see over here in April. And in March, it struggled to stay above it, leading to a breakdown. That then that was caused in part because of China. China's clamped down on cryptos, but since then,
yeah,
the markets have had time to absorb all of that Chinese news, and then decided that Bitcoin was still undervalued, and so it broke up to a new high above the previous all-time high. The new record is at almost at 6,700. Sorry, at
67,000.
$67,000. And I think that level will break again because of how price action is unfolding here. The market has formed a base, as I said, around the 6,000 area, 60,000, not 6,000, 60,000 area, breaking through this bearish trend line cleanly. If it holds above the point of origin of the breakout at 62,400 today, that would be another bullish signal that could see prices not only test the previous high, but probably break through and maybe even reach for 70,000. Who knows? Um, Bitcoin is, you can never predict how high this thing could go because clearly demand from institutions is very strong. Everyone wants a piece of Bitcoin. At the same time, supply of Bitcoin is limited. Uh, Even if there's no use for Bitcoin at the moment, it's the ultimate coin to have in the crypto space, right? So for now, it remains the dominant coin, and we may even see 70,000 in not too distant future. Let's go back to indices because I want to mention a few others. We did talk
Sure.
extensively about the S&P 500 hitting a record high and so on.
What about the Nasdaq and the others?
Yeah, Nasdaq as well has broken to new high. All the major US indices look strong, but I reckon the next big rally will come for European markets now, because
All right.
while the Fed is going to be tapering its asset purchases, the European Central Bank has indicated that it's not in a position to slow down purchases just yet. The Emergency Pandemic Purchase Plan, or the PEPP, by the ECB is going to run its course and remain until at least March of next year, meaning that the money supply in the Eurozone is going to continue to grow. And this should be good news for European stocks, I would imagine, the same way that QE has supported the US markets. So I reckon the same way European markets are going to benefit from it. And the German DAX index is very close to its previous all-time high. I reckon it's going to get there, possibly by the end of today's session. If not, maybe later on in the week. There's a very nice hammer candle that was printed a few days ago. The base of that hammer remains a key support that needs to hold. The head of that hammer, I should say. So far, we're holding above that hammerhead and the point of and the previous resistance area, basically the shaded region. And so we tested that level today, and we broke out to a new high for the month. But could we now rally to the previous high? I think it will get there. It's just a question of time, in my view. Other European indices are likewise looking very strong. And one of my favorite ones right now is the Spanish IBEX, because I've been looking at this market for a while, expecting a big breakout from this consolidation zone, which we finally got a few days ago. So this breakout, if sustained, could see the IBEX hit a new high for the year. and possibly go much higher from there. The Ftse 100 is another index that I've been expecting a big breakout, but so far it's not really moved as much as I had expected. It broke above this 6-month-old consolidation range, created a bull flag here, and it broke up above it, retested it, and then it went higher again. Today it's pulled back a little bit, testing the previous highs here. And so we could see a rebound from the lows and a breakout to new highs later in the week, depending on the outcome of the major central bank meetings this week. The Ftse thus remains bullish despite today's weakness. Likewise, if you look at the Euro Stoxx 50 index breaking to a new record high, the Euro Stoxx 600 index nearly breaking to a new record high. The French CAC index is testing the previous high that was hit in August. So it's risk on, in other words, for European markets. And if you feel like you've missed out on the major rally for the US indices, I think it might be time to look at the European markets and expect some further upside potential in these markets until the charts tell you otherwise. But for now, it looks quite bullish. We haven't talked about crude oil prices. No, we did talk about crude oil prices, but they remain kind of. We did talk about crude oil prices. What didn't we talk about is the pound. Or did we? We talked about the pound as well.
We talked about the pound.
I feel like
the euro pound.
The euro pound. That's it. Yeah. The euro pound has broken back above the shady region.
One because because we have observed, obviously, the expectations of a rate hike have been dampened down, and anyone who went with the breakout is now underwater. So if the Bank of England doesn't hike rates tomorrow, not tomorrow, on Thursday.
On Thursday.
This reversal could turn into an ugly one, and we could crawl all the way back up above 86.50.
Yeah, the line in the sand for me is 85.25. This level was the last support prior to the rally that ultimately failed, and then the market broke down below it. So that level is the line in the sand for me. For as long as we remain below that level, there is still the potential we could see for new lows for the year on the channel. But that level is, really ideally we shouldn't have got to anywhere close to it again after how the markets broke down in recent weeks. Perhaps it's driven by profit taking from the short that had been accumulated here ahead of the Bank of England meeting. Who knows? In any case, if the market breaks this level, then I reckon that's it for the European shorts. And then we have to wait for fresh signals at much higher levels to emerge before looking at the European on the short side again. With that, let me thank you so much for joining us today. It's been a pleasure. I hope to see you guys in one of our upcoming webinars. Do you want to talk a little bit about the upcoming webinars, Victor? Or
sure. We actually have one on the non-farm payrolls that is coming up on Friday. And if you're keen in trading cryptocurrencies, we're going to have another one dedicated to the meme coins and to all the craziness that's going on in the crypto markets in the coming week. But stay in touch with our calendar on the webinars page, and we'll be updating it soon.
Yeah, we'll have more webinars listed here. But the next one, as Victor mentioned, is the NFP webinar, which is happening on Friday. Our live market analysis session today's session will be returning next Tuesday, and As Victor mentioned, we have that crypto one as well. So to get there, you go to market analysis on our website and go to live webinars to get to this page. Thank you so much for joining us. I hope to see you guys in one of the upcoming webinars. Take care now.
Take care. Bye-bye. Good luck.